Hello, my name is Penelope Hawkins. I work at UNCTAD, and it's a real delight to be able to moderate this session, not only because, of course, it's a privilege, an opportunity to engage with young scholars, but because today's topic is so exciting, theoretically and in reality, and of course, because we have an illustrious panel of speakers. In UNCTAD, when we talk of development finance, of course, we are talking about a very broad range of research topics. For example, we include within that the role of development banks. We include within that domestic resource mobilization. We look at taxation. We look at illicit financial flows, including both tax evasion and tax avoidance by big corporations. We look at official development assistance. We also look at both multinational and official lending, both concessional and non-concessional, and of course the role of private finance within that. And not least of course, we have a long history in trying to promote principles of responsible lending and borrowing. So it's a very broad and exciting topic for us. Before I begin today's session, I'd just like to mention a few matters of housekeeping. We have around about 25 minutes for each of the speakers. That leaves us about 5 minutes of question time per speaker. We've made a decision to push that all to the end of the session. So please, if you have a specific question directed at a specific speaker, then perhaps just mention for whom you would like to have the question addressed. But otherwise, we will deal with them in general at the end of the session. And then secondly, tomorrow we have a change of program. Unfortunately, Daniela Gabor, who was due to speak, is going to be replaced by a senior UNCTAD colleague, Diana Barraclough, who is going to speak on public banks and a greener future. So without any further ado, let me begin by introducing our first speaker, who is Pablo Bortz. He is a professor of macroeconomics at the University of San Martin in Argentina. He has not only a wealth of academic experience and contribution, but has also worked in the Argentinian Ministry of Finance and Foreign Affairs, and has also worked within the Central Bank of Argentina. So welcome, Pablo. We're delighted to hear from you.
Thanks a lot for the invitation. It is an honor to be part of this panel with Anastasia, with Stephanie, and it's an honor to be presenting here. Let me open and share my presentation there, like that. Well, the topic that I was asked to talk about was financial liberalization from a developmental perspective. That means first that I will focus more on, from the point of view of emerging economies. I come from one, from Argentina, which has suffered numerous impacts and instances of the negative effects of financial liberalization. The structure of my presentation is as follows. I try to look for an example in the Greek mythology of a being that was transformed, that suffered transformations. And the example that I came up with was, hold on one second, was the Scylla. Let me see one thing that I have trouble here. There was Scylla. I will mention it in a bit. And so first I present what was the intended description of the Scylla. And you, for those who don't know the Greek mythology, I will tell you in a bit. And then different transformations that have happened in the last 4 decades, 4.5, almost 5, since the beginning of financial liberalization after the dismissal of the Bretton Woods arrangements. I will end up with pointing towards a few transformations that can be envisioned for the future. I mean, every forecast piece must be taken with a grain of salt. Nobody knows the future, and certainly the less we know in these uncertain circumstances that we face. But I think that I wanted to point towards some new developments that have arisen and have been identified in the last years. Sila was a beautiful girl who was not engaged but admired by some god, and some jealous goddess turned her into a monster with 6 dragons, with which spitted fire, which engulfed the sailors. It was a sea monster. Allegedly, Sicily is named after Scylla, and it also makes an appearance in the Odyssey. But in its original beautiful human form, why did I choose this character? Because at the beginning of this period, in the mid-70s, there was a literature that fostered financial liberalization, both domestically and internationally, for emerging economies. This financial liberalization would bring stable, efficient, and affordable long-term finance, coupled with for which it was required to deregulate both long and short-term movements. Second, since the capital markets in developing countries were underdeveloped, this financial liberalization and would attract foreign savings to develop the short-term market and to provide long-term finance, in order to overcome what was the alleged negative effects of financial repression. I don't know if you heard that phrase. I think it was coined by Ronald McKinnon or Gurley and Shaw. I don't remember which of the authors, but it was coined in the 60s and 70s, and coming from a country that had actual repression. It's a near-king expression, to say the least. What was promised, well, that finance would flow from stable finance, would flow from north to south, would increase savings and improve allocations by freeing interest rates. Interest rates were controlled throughout the world, and certainly in emerging economies. And at first, this lending of funds from the north to the south was channeled through private, mainly banking finance. You must remember that this was the time of the oil shocks, 73, 79, which implied that there was a lot to lend, a lot of funds to recycle, and so the lending to emerging economies, to communist economies at the time, really took on an upward trend, substantial. There were many sources of capital inflows to emerging economies. If there was an imbalance, floating exchange rates would do the adjustment and the trick. Now, the Scylla was transformed through a poison put in the water where she was taking a bath. what was the first impact of this poison, the first transformation? Well, the 1980s debt crisis. In Latin America, it first the main I would say 3 countries in which it bursted first was Chile, Mexico, and Argentina. But it also affected the whole region. Also Brazil, through bit different channels, but it was also an external debt crisis, Colombia, Peru, etc. But it was not only in Latin America. Yugoslavia, Poland, Romania, they let's say, like I mentioned, communist countries as well were affected, Africa. So this was, we usually I usually refer, and many other scholars refer to it as the Latin American debt crisis, but that is mistaken in its summary. It engulfed many, many regions in the world. And it was not only an external crisis, a balance of payment crisis. It involved domestic financial crisis. Argentina had one, Chile had one. And it involved as well a trade crisis because it was a period of very low commodity prices for emerging economies. This is for the debtors. For the creditors, how it reflected was through the weakening of the capital positions and capital solvency of US, of American banks, which were, as I mentioned before, the main lenders. So there comes the first transformation. The solution was the Brady Plan. Previously, an attempt was made through the Baker Plan. It didn't prosper. It didn't. It wasn't successful. So then came the Brady Plan, together with a whole bunch of other things, grouped in the Washington Consensus. The Brady, in what refers to financial liberalization and development finance, well, it shifted lending from private banks to the private bond markets for public and private borrowers, for short and long-term lending. It also involved privatizations, structural reforms like labor market deregulation, lifting of trade controls, capital controls, etc., etc. What was the role of official lending? Mainly World Bank, one could say, but also several regional development banks. Well, the lending was reduced and focused on these structural reforms, poverty alleviation, focalized programs for poverty alleviation. There was also tied and concessional official development assistance, in which development assistance was tied either to buying goods and services from the donor country, or it happened through reducing interest cost, not just granting, right? But you needed to borrow in order to get the assistance. As I mentioned, Sila had, after it was transformed, had like 6 dragons. It became an awful monster. And in the Odyssey, once Ulysses goes through this strait between Sicily and Italy, if I'm not mistaken, it passes, he gets distracted, and Sila takes 6 of his sailors. So one could mention 6 victims of this second transformations of the SILA, but actually there were a lot more. Mexico, East Asia, Russia, Brazil, Turkey, Argentina. You see this list of countries. East Asia, well, we know it includes Indonesia, Thailand, Taiwan, etc. That had all suffered crisis at the late 1990s. And in the case of Turkey, Argentina, early 2000s. But as I say, these were not only 6. I can include Colombia, Peru, Eastern Europe, and a whole bunch of other countries. So what were the solutions for this attack of the SILA at the time? Well, the first one was to there weren't many attempts to redraw the boundaries of financial regulation and liberalization, but to create to build some protective measures, protective how to put it, a bullet chest to prevent the impact or the effect of this negative the negative impacts of financial liberalization. The first one and main policy was reserve accumulation. Now, I must, there is no consensus in the literature about the positive or negative effects of reserve accumulation. I'm very much in favor, I want to state it, to put it on print. A second decision was to avoid calling the IMF, like under no only in the most extreme circumstance you should call the IMF, because it's a poisonous solution as well. It must be said that at the time there was an increase in commodity prices that helped a lot of emerging economies in various degrees. This commodity price boom triggered an inflow of FDI, mainly into the primary sector, because obviously it was linked to agricultural and mineral products. Some countries adopted macroprudential or capital controls, but mainly and mostly on capital inflow. A new wave of reforms happened and transformations happened after the global financial crisis. The first one was named blended finance. I think that tomorrow the new presenter will talk a bit about these effects. If not, I had to modify this slide at last minute because obviously the expert on blended finance is Daniela Gabor, and I really recommend everybody to check her work. But what is the gist of blended finance? To use official lender as catalyzer, as risk absorber of private lending, so that the bond market, private investors can safely invest in infrastructure, in climate works, in education, in health, in anything you can think of, with official lending taking the first tranche of risk, being subordinated debtors. In a sense, a similar logic to PPPs, to public-private partnerships, that it really came about in the 90s and are facing a new push for its adaptations. And this of blended finance also involves a definition of the role of multilateral development banks, who also should take on the first most riskier investment. This new transformation in turn involves new markets, new actors, new instruments. new channels. What are these new markets? Local currency bond market, both domestic and external. There has been a development in emerging economies of this external debt in local currency, which, let me be clear, they are better than foreign currency debt, and I don't argue about that, but they still have troubles, and we have seen many of these troubles in with the COVID-19 pandemic in March 2020. And the main trouble is the involvement of non-resident investors in these local currency bond markets. There is some work even by UNCTAD, by the BIS, which I really recommend everybody to look at. And so in this sense, one lesson that one could draw actually is not new. It dates back to like 90 years ago. And it was, one could quote a slogan by Keynes, which is that above all, let finance be national. New actors. It's not mainly new, but that they came again into the spotlight. And I mean non-financial corporations. They were active in the 1970s in Latin America, mainly in Chile, somewhat in Argentina, Mexico. They were active in Asia in the 1990s, and they are certainly active in the 2010s. Now, there are not many non-financial corporations from emerging economies that borrow heavily in international markets and in dollars. There are not many, but they are big and they borrowed a lot. And these are systemically important companies, right? Operating mainly in the primary sector, in construction, retail, and finance. New instruments. There has been a generalization of derivative instruments as speculative investment and as hedging investment. And this has prompted macroprudential policies for good and for bad. For good in the sense that it has forced regulators to how to put it, to take into consideration the risk of derivative investment. In that sense, that is good. It is bad in the sense that it has been adopted by other countries. Private hedging has been adopted by other countries as a new way of, hedging, covering, for instance, currency exchange risk. And one thing you should know at this time, from only experience with successive financial crises, is that risk does not disappear. It gets shifted from an investor to another, and at times it gets amplified, unless the actor holding that risk can actually bear it. Private markets are not so good for bearing this risk. There has been also development of new labels for bonds. A label for each need. You have ESG labeling, you have catastrophe bonds, you have pandemic bonds, you have obviously gender bonds, you have a bond for everything. It's not clear, for instance, in environmental matters, that these bonds actually reflect environmental concerns. There is a debate about the green taxonomy. ESG bonds ratings are not correlated among credit rating agencies, at least not even around 50% of correlation, which is, one would assume that, a green investment is clear. This is green, this is not green. Well, that's not the case. What new transformations can one forecast for the future. Well, here I wanted to emphasize one that I've been thinking more and more in recent years.
Pablo, so may I just confirm you've got about 3 minutes?
Perfect. This is my last slide, so I'm right on time. And I think there has been in recent years some works about a new style of fact, which is that when foreign capital flows in, non-resident capital increases, non-resident, that means like external liabilities increase, so does domestic capital flow out. That means external assets increase. So one is to look very carefully at the trends in external assets of emerging economies. We know that there are some, mainly China, emerging economies now acting as capital exporters. We know that China has invested in Africa, in Latin America. It has the Belt Road Initiative, etc., etc. But so do other countries through sovereign wealth funds, and there have been also private actors from emerging economies acting as capital exporters. I mentioned financial corporations. For instance, I was in a webinar a couple of months ago, and Latin American banks have become more internationalized, are operating in other countries, and that creates problems to the home country regulators. But the point I really want to make is that the type of external asset matters, the type. One thing is to have an increase in reserves, to have an increase in FDI is not the same as having an increase in loans or an increase in deposits. We are all used to capital flights, and that involves an increase in deposits, say in Switzerland or in tax haven countries, etc. But that has not the same relevance as banking, as banks lending abroad, as companies investing abroad, or as central banks building up reserves. So that was, I think I'm right on time. Thanks a lot for the invitation and listening. I will share with you these presentations, and you can contact me via Twitter or at any of these other channels. And I will stop sharing screen right now. Perfect.
Thank you very much, Pablo. Very dramatic and exciting use of the Greek mythology to dramatically explain to us what has been poisoning us for all of these years. There was a very instant question that came up as you were speaking about, are all emerging markets the same? And of course, we would say, no, that is not so. But before we get into the questions, and you've stimulated a number of them, if I could just remind all of the participants to just add their questions into the Q&A session. We will be dealing with the questions at the end of the session for all three speakers, so please do that. But thank you for that very dramatic discussion. And indeed, for us at UNCTAD, we are very concerned about the bond obligations of countries, particularly those in Africa and Latin America, moving up to 2030. I hope we have a chance to talk about that a little bit more. But allow me now to introduce our next speaker, who is Professor Anastasia Nesvetailova, who hails from London. She has been at City University of London, where she not only directed the City Political Economy Research Centre, but was Professor of International Political Economy. And of course, gives me great pleasure to introduce her as the very new head of macroeconomics, the branch in our division, Globalization and Development Strategies. She's our newest recruit, and we're delighted to have her. So Anastasia, we're listening to hear what you have to say about Minsky. Thank you.
Thank you, Penny, very much for the introduction, for the kind welcome. I will now be trying to share my screen nicely so that it works. I will minimize the view of the gallery. And I will go into slide view the way we rehearsed. And hopefully it will work. No, it doesn't work. Yes, a little bit. Okay. Just a second. Something is. Okay. I think I will. Can you see? I hope you can see.
It's excellent. Thank you.
Thank you. Thank you very much for confirming. It's particularly exciting to actually have this title for the presentation. I have to say that I first encountered Minsky, Hyman Minsky, through a footnote. I had no idea who he was or what his work contained. But I was writing a thesis on the global financial markets, and I was particularly puzzled, annoyed, intrigued by the question of global liquidity. It seemed to me at the time that the innovations that were stretching the monetary frontier made the global financial system progressively liquid. But the literature that I was able to work with all maintained that, in fact, global capital markets are now awash with money and capital. There is more and more liquidity to them, and I intuitively felt this is completely wrong. It cannot be. It's probably very unstable. And the only information that potentially could confirm it came in a footnote into the work of Hyman Minsky. I had to go into a very special reserve library, get the only book available at the time, photocopy it, and then treasure it for the rest of my PhD work and actually the career afterwards. I still have it as a token. He was a very unknown scholar. His name wasn't known beyond a very narrow frame of heterodox economics. He didn't really have an impact on global political economy debate at the time. So it all changed, of course, in 2007, and that's why it's really an honor and quite a remarkable moment to actually have the opportunity to discuss a Minskyian perspective, in fact, on anything, but in particular on development. But let me introduce the man himself. Probably some of you have already known at least the name, because he now appears in the press. His books are bestsellers on Amazon. There is a special archive in New York, in upstate New York, dedicated to his legacy. And there are a lot of young scholars working on this tradition. I have to reiterate, at the time, and you're talking about late 90s, early 2000s, a lot of my then fellow PhD students in economics complained that they simply were not allowed by their supervisory boards to work on Hyman Minsky in their thesis and their research, because he was considered to be unsuitable for actual research work in economics. His work wasn't considered to be quantifiable, mathematical enough, and modelable enough to be credited or credible in economics profession. So let's ask the question, to what extent Minsky is in fact a scholar on his own, or does he belong with any wider economic traditions in the history of economic thought? Traditionally, and the early Minsky called himself, I think, a post-Keynesian or a financial Keynesian, if you want. In fact, his first monograph, called John Maynard Keynes, is very much his own interpretation of the legacy of Keynes and what he thought was true Keynesian tradition for post-1945 American economy, advanced American economy. And I think broadly now, if there is a course in universities or a research monograph, he would still be considered broadly within Keynesian or post-Keynesian traditions of economic thought. Interestingly enough, there are now colleagues who are writing and practitioners who are saying that actually Minsky and Keynes are two very different authors and theorists of capitalism. Keynes was concerned with very unstable economy. He analyzed, the legacy of depression and very short-term solutions. Minsky was focused on something completely different. He was interested in the dynamics of optimism, in the dangerous impacts of optimism, in what can be done beyond the immediate short-term period. And he was probably much, in some way it's provocative to say that, but in some way he was much more deeper in his understanding of endogenous dynamics of capitalism than Keynes himself. But this is just, I'm introducing one debate to you, and I would be happy to answer questions or give you more literature on that. His initial PhD supervisor was, of course, Joseph Schumpeter. So Minsky is often linked to Schumpeterian tradition in economics, mostly because of his work on financial innovation. But then I think it still remains on the margins of economic theorization, partly because Schumpeter, I think, died very quickly after he assumed the supervision of Jan Hyman at the time. There is also some work on linking Minsky and the Veblenyan tradition in political economy, again through the use of innovation and some of the legal aspects of capitalist evolution, but I think it can be expanded even further. And finally, and interestingly, Susan Strange, in fact, the mother of international political economy as a discipline in the UK and I think in North America broadly too, she actually dismissed this link between Minsky and wider economic traditions. She said, she called Minsky was always the loner. He wrote and he worked very much alone outside of the big traditions of economic, if you want, religion of mainstream economics. His work was not interesting to students or scholars at the time, and although he published quite prolifically for an economist at the time, his thinking was far too original, very uncomfortable for the time. He was talking about, the state. He was talking about very dangerous dynamics in an economy that was supposed to be booming. So he was really dismissed by all main traditions of economic thinking. So with this introduction, I will ask a provocative question to each of you, and maybe you can have some fun thinking further about this after the lecture. Was Minsky even a Minskyian at the time? So with all this spectrum of potential tones to his scholarship, was Minsky even a Minskyian? Now that we're writing various articles, theses, and books about a Minskyian interpretation of this or that event, is there even enough to his scholarship to delineate such a tradition to him? And therefore, can there be a Minskyian perspective, in fact, on anything, but in particular on development today in 2021? So let's start thinking. Minsky likes to joke that he didn't joke. He analyzed the financially advanced economy, but then he acknowledged that he mostly was focusing on very close system of very advanced, financially advanced American capitalism of the time. The question that bothered him throughout his career was whether the Great Depression can happen again in now very established, very booming, again, financially advanced economy of the 1970s, 1980s United States of America. Randall Ray, one of his students, would call this tradition a money manager capitalism. And it was very much about, Minsky is usually considered to be a theorist or an analyst of the financial system predominantly. His view of the system was quite pessimistic. It was a portrayal of an economy, very inherently unstable economy that is always punctuated by financial crises, implosions, and most dangerously followed by debt deflations and deep recessions. He acknowledged that analyzing all the dynamics in American financially advanced capitalism, he did acknowledge that a Great Depression can in fact happen again. There are all sorts of tendencies, regularities, dynamics that can spur it again. But the advance of this financial capitalism is such that there is enough of thinking and institutional power to prevent such a depression from happening again. And he designated two institutions to deal with it, which I will focus on in a few moments. The Heinz picture on the slide is to illustrate his joke or his metaphor. He was an analyst of capitalism, acknowledging that capitalism is a very clever mutant. Capitalism is fragile, it's endogenously unstable, but then of course it is robust enough as a system to transform itself into something much newer and more dynamic and more inclusive. When asked which capitalism are you analyzing? He would say, well, difficult to say because there are as many varieties of capitalism as Heinz has pickles, which I think remains the figure 57. If you go to your supermarket, now you will see the label, the trademark of Heinz on any can, and there will be 57 varieties of capitalism there. So I would say that we can take much more from Minsky scholarship than just his view, his pessimistic interpretation of financial dynamics and this upward instability. There are two particular concepts that make Minsky's tradition into, I would suggest, a theory, not just a framework. He was very modest. He called his main contribution, financial instability hypothesis, a hypothesis. It wasn't, he didn't say it's a theory of anything. It wasn't for him a theory of the financial system. But with some hindsight, I believe that we can actually designate Minsky as the theorist of capitalism, mostly because the two key concepts in his thinking were volume was enough to produce enough of conceptualization for us to understand the systemic dynamics further. One such concept was money, which he reiterated mainstream economics did not have any accommodation for the special role of money and the financial system as it plays in the economy. It used to be a servant. For Minsky, it was absolutely the key institution. Unusually also, he dismissed all sort of older traditions of, barter money, the functions of money, and the authority, the political interpretation of monetary origins. He said, it's not an interesting question of who is creating money in the economy, be that banks, be that private agents, be that financial innovators or any other credit institutions. He actually firmly and very much ahead of his time, he said anybody can create money. The problem is getting it accepted. And then he continued that, of course, the institutions and the networks, the set of relationships that assures that this token, this money is getting it accepted, is precisely what makes financial capitalism robust, fragile, dynamic, or not. In this interpretation, the function of the banking system for him wasn't about intermediating between savers and borrowers and creditors and debtors. No, it was about assuring the creditworthiness of the parties. And this what makes, again, his insight into financially innovative capitalism so much ahead of the time. He was writing this in the late 70s, early 80s. And now when Bitcoin is upon us, when we really live in the world of digital credit and currencies, you can understand that this is exactly what the banking system, in fact, is doing, regardless of your level of development. And then in a most complex way and most controversially, he would reiterate that finance is always and everywhere fundamentally a credit system and therefore a debt system. It is driven by debt relationships and debt valuations, and therefore it's A, risky, but B, in order to understand it, you need to understand the economy of balance sheets and how they relate to each other, because each one of us is essentially a set of balance sheets. The second concept that marks his theory is the lack, in fact, of such a concept, and that would be the concept of equilibrium. Against all traditions of the time, even, I would say, radical political economy traditions, he said that the economy operates very well, unpredictably, but very dynamically outside of any concept of equilibrium. It's not necessary for our understanding of the dynamics. And given the interdependence between past, present, and future, advanced capitalist economies cyclically fluctuate in a perennial disequilibrium. It was a very normal state of affairs for him. It's not an aberration from any balance of power or balance of prices. It's an absolutely inherent characteristic of a financially dynamic economy. The financial structure predictably or correspondingly but unpredictably changes during this particular cycle. As optimism, as expectations of economic growth or financial stability or new economy or some sort of great technological innovation that sets upon us, as optimism sets in, it leads to increased indebtedness across the economy, which has its own dynamics. But at some point, this optimism and this financial transformation does end in an implosion. He immortalized the name of Carlo Ponzi. You see him here on the black and white photo, because of course it's the famous taxonomy of finance that Minsky developed. A financial system develops through hedge, speculative, and Ponzi financial states. And it is Ponzi units that are the most fragile and dangerous for the stability of the system. If you want, you can look at the slide in more depth, but essentially it's a very schematic representation of the logic of how financial fragility matures into a financial crisis or an implosion. Liquidity illusion here, with the reference to my work, is an answer to why this transformation can be concealed for some time, why it cannot be noticed maybe in advance, why it cannot be very visible to regulators or to observers. Interestingly, Minsky had a relatively benign view of speculation. Speculation for him is still a state where risks can be managed. Speculation is already a stretch of initial very safe condition of financial and economic units, but it's still quite manageable because your incomes can just be enough to satisfy your debt liabilities. Ponzi financial state is, of course, the equivalent of you paying your Master credit card with your Visa credit card. It's when all debts can only be paid or settled by acquiring new debts. It's a classic Ponzi pyramid. The black and white picture on this slide is from the movie Margin Call. It's a fantastic story of the financial crisis of 2007, with Kevin Spacey at the center. It is based actually on a fusion of two true stories of Lehman Brothers and JP Morgan. And if you have not seen it, I think it's the best item out there in popular culture that can kind of put a behavioral, human, psychological, but also a financial tone to what happened in the summer of 2007 and then 2008, and why particular formula didn't work out. So it's just for entertainment. Going further, I would say that Minsky's view goes much beyond the financial taxonomy, much beyond the logic of financial fragility, and even beyond his modest interpretation of financial instability hypothesis. I would say there is a theory of capitalist evolution, and which has pertinent lessons for development. To sum up, or to tease out the elements from his framework, we know that he argued correctly that financial system is expandable, endogenously so. Because credit creation itself is an endogenous set of processes. It's about stretching the financial system by those who may not be officially designated to do that, but they are embedded in the network who assures the creditworthiness of the parties who make sure that debts are valued and have a price. Financial innovation to him does drive growth. It's an inevitable component of economic growth, of expansion and progress, but it is inevitably destabilizing and therefore dangerous. Financial innovation and economic stability are at odds with each other. There is always a trade-off. You either want to have a financially innovative and dynamic economy, or you want to have a very stable, repressed, if you want to use the term that Pablo mentioned in his presentation from McKinnon, you want to have a very stable golden age of capitalism, where crises do not happen, but then of course you pay a price of very subdued, repressed, in some way exclusionary financial system and credit system too. Therefore, financial capitalism as a system is unstable, but unpredictably so. We know that crises do occur. We know that they will happen, but we cannot ever time them or say which type of crisis it will generate. And in order to avoid the most devastating type of crisis, i.e. the repetition, for example, of the Great Depression, of a huge debt deflation that would mark economic stagnation, there needs to be a stabilizer in the economy to avoid such an event. To Minsky, that stabilizer contains two institutional pillars, a big bank and a big government, as he said. And of course, knowing what happened in 2007 and 2008, we know that although we're all supposed to be Minskians now, only one of these institutions was used in managing the crisis, and that was the big bank. The big government, the big state, in fact, was not only not used, but it was shrunk under the name of austerity in many economies that suffered the most painful legacy of the financial crisis at the time. Stability is destabilized.
Anastasia, sorry, you've got about 3 minutes now.
Thank you, Penny. Okay, stability is destabilizing. This is the phrase that he will ever be remembered for. As Pablo already mentioned, throughout all crises in emerging markets, Minsky's idea was not relevant. He was completely dismissed because all those contagions were explained by very specific factors that concern development. It was either about current account deficits or corrupt governments or hyperinflation in particular countries, something about weak or underdeveloped financial markets. So Minsky was supposed to be not relevant for any emerging market or any development for the time. At the same time, in advanced economies, those crises that did happen, in particular banks or corporations, were oddities. They were not regular events, or if they were, they were very normalized in the overall cycle of economic boom and evolution. At the time when financial system was also becoming apparently more liquid and awash with capital, as Ben Bernanke put it in 2006. That was all, of course, until the summer of 2007, when all news screens and paper periodicals started to feature phrases like Minsky moment in either banking system or financial systems. Suddenly, scholars discovered Minsky and his apparent critique of financialization, and even now there is already a conversation, academic conversation, about a Minsky moment in climate change or in climate governance. I would say that Minsky himself never actually used the word Minsky moment, doesn't appear in his texts, and of course he never wrote anything about financialization. Why? Because the moment for him, or for me and for some other scholars, is of course not the moment when Ponzi schemes start to collapse. A true Minsky moment, in light of the institutional framework of his scholarship, is when the big bank and the big government start to interfere into the economy in their interventionist presence in order to avoid Great Depression or debt deflation from recurring again. This is exactly what makes him not just an economic theorist, but I would say a political economist beyond the simple financial analysis that he's usually associated with. He did analyze processes and dynamics of a system as a whole, of this capitalism that has so many varieties and is so capable of mutation. Capitalism for him was primarily and fundamentally a financial system where, and this is very important for those who like to talk about speculation, financialization, how bad those things can be and how counterproductive or harmful to the real economy. Minsky didn't make a distinction between the two spheres. In fact, he kept talking about the prices and behavior of capital assets. And so if you want, he was the first theorist of asset capitalism rather than just a financial capitalism as such. He did place particular stressing on the prices and earnings from these capital assets, which he defined as power of generating plants, factories, farms, and even housing. His financial interpretation of financial instability hypothesis is really about futurity, or in other words, the political economy of tradability of debt. It is not really about backward-looking economy of capitalist accumulation, savings. No, he was very much an institutionalist who understood the necessity, but also dangers of discounting future earnings into today and the value of income, wealth, and assets. So, just as I said, he was really a first scholar of asset capitalism, a system where valuations of capital assets and tradability of debt are key to the functioning of the system as a whole. In order to avoid breakdowns of the system, this inherently unstable environment needs to have institutional stabilizers, the two of them that I mentioned. And while Minsky moment only implies the role for these two institutions in a crisis from a perspective of any developing economy. And I would say for any economy, the state and the bank needs to continually maintain this pricing of capital assets, output and employment, as well as the tradability of debt, i.e. the financial network. So there are a few quotes that I think I will now let you read in the PowerPoint presentation that would be available afterwards. He basically called for the re-emergence of big government and big bank and interventionist mode in capitalism, having witnessed the crisis of the previous model of capitalism in the 1930s. And stretching it to today or transforming it to lessons of today, I can only suggest that we are really in a potentially this Minsky moment of transformation, because we clearly are witnessing post-COVID, post-pandemic, and post the failed lessons of 2007, a crisis of corporatist oligarchic forms of ownership in capitalism, which was founded on the idea of market rationality, individual incentives, and a reactive state. I would not say that this neoliberal model didn't have any place for a state, but it was very much a reactive phenomenon. Minsky's view of development would foresee a role for both institutions in governing the system of valuation of capital assets. He would not separate finance and the real economy, at least that's how I believe, or how I read his scholarship. And maybe to focus or finalize on a more positive note, environmental crisis that we're witnessing today from a variety of angles does present both a crisis, but of course an opportunity for a Minskyian developmental state where valuations of new types of assets would now be firmly on the developmental state agenda. And with this, the only lesson that can come from him directly is that whether a crisis, a systemic collapse can happen again, Minsky would probably say, yes, it will for sure. We don't know how it would look or what type it would be, but we need to be institutionally prepared to avoid it. With this, Penny, sorry if I ran over. I finish and I will stop sharing.
Thank you so much. That was an excellent discussion of Minsky. I'm sure it was fascinating. It stimulated a whole host of questions, and indeed some areas of commonality between the presentation of yourself and Pablo. We've been told that unfortunately Stephanie Blankenberg, who was our third speaker and who we were hoping would join us, has got profound computer problems today, so won't be able to join us, but that gives us a wonderful opportunity for us to extend the discussion in this fascinating area. So Pablo, if I can ask if you perhaps could also join us on video. And,
yes, but I'm not allowed to share my video, but yes, I'm willing to.
I'm sure Claire will deal with it. Wonderful. Okay, so here we are. So there's been this fascinating discussion which one can follow through the Q&A area, and I think there's some things that I think would be very helpful for us to perhaps make links to. I think very early on we started to have questions and issues related to this blended finance and public-private participation, this kind of combination of how does this actually affect development in developing countries. We can see that certainly from the UNCTAD side, we know that there's huge pressure because we have so over many decades diminished our state sector and the capacity indeed of governments in many developing countries, that there's now been this big call that private finance must fill the gap, certainly for the SDGs investment, but any other kind of development requirement. And we've seen that from work that we've done here, but also many other scholars have pointed out that PPPs are not always successful. In fact, there are many reasons why they're failures. Even in developed countries where there are very sound governance and, shall we say, organizational checks system checks in the, and indeed, in spite of that, we find that in places like the UK, for example, PPP has been now judged to be more expensive and less, should we say, beneficial to society as a whole than if the government had in fact even printed money and then undergone that work. So I don't know, I mean, I think there is this issue that comes out of both your work, Anastasia, about big government, and then of course also Pablo, the work that you've referred to as government as the risk taker. Perhaps you would like to comment on that. Perhaps I can start with you, Pablo.
Okay, yes, I actually, in the readings I recommended for my presentation, there is a chapter of a trade and development report of 2015, which actually, if I'm not mistaken, it was written as well by Diana Baroncroft, that we'll present tomorrow. There are very few instances of successful PPPs. I can tell you from the Argentinian experience that it involves substantial risk. It involves not merely expenses, but future damages, because it involves litigation in dispute settlement, international dispute settlements, which are a lengthy process that may involve as well more and more costs and problems. They don't deliver the goods mostly. There are many instances that they don't deliver the goods. And as you mentioned, the case of UK, which was the originator, the creator of the very idea of public-private partnerships, abandoning and questioning its previous long-held stance, I think that speaks volume to the risks involved in there. In the case of Argentina, I can tell you that there was an attempt by the then government, previous administration, to implement PPPs, and the risks were so high that the IMF shut it down. When we had, when we asked for IMF finance, the government wanted to have the PPPs expenditure, let's say, below the line, right? Not counting as part of the primary deficit. And the IMF said, no, it should go over the line. It should be part of the imagine. So even the IMF had reservations about the development of PPPs and how it may turn out for public finances. So I really think I understand that there may be some diminished state capabilities and capacities. I would focus more on that rather than on what can PPPs bring about to the country. That's I'm very skeptical about PPPs.
Thanks, Pablo. Anastasia.
Yes, this is a really topical and interesting question, partly because in addition to traditional early forms of PPPs, there have now been so many kind of hybrid forms of financing, including when financialization of financial instruments are being applied to solve social or even humanitarian problems, prison bonds. I forgot the other name, but really there is now a very wide spectrum where particular calculation is being applied to some success, but there is a very broad question of why to install really a new set of intermediaries for the problem that really is fundamentally public good. I would say that to me the key question of conceptually of blended finance or this fusion between the state and the private sector is precisely with the concept of risk taker. The state as a risk taker assumes that risk is being calculated, understood, offered, placed by somebody else. The standards for understanding of this risk don't belong with the state. It's supposed to be whatever the lender of last resort, the market maker of last resort, the payer of last resort, the risk taker of last resort. But really the standards all come from the outside. They come from the financial technologies, they come from actors who have been doing it in other different spheres of economy and society. And I think we're now at a time, especially with the enormity of a public good crisis environment, of really needing to move beyond the threshold. The individuated approach to risk, the understanding that this risk is fundamentally divisible, it's priceable, it's therefore replicatable. There is something new there. It's uncertain. It may not be necessarily priced well. This risk is unmatchable in previous or existing models, and therefore it calls for a very different role of the state, not just as a risk taker. It needs to be a risk pricer. It needs to be the standard setter for valuations, and it needs to be acknowledged as an authority on that. And it's an opportunity also for developing countries to think further on how to do that, not to accept somebody else's standards, but to actually say, no, this is our data, this is our risk, and this is how we understand it.
Excellent. I think this notion of having a strong and competent state runs through Minsky's work, and indeed the work of UNCTAD, in terms of emphasizing that there does need to be this balance of the very strong private sector, particularly the financial sector. The question that comes out from both of your work as well, from the narrative and the Q&A, is the role of MMT. And one question was, do you see Minsky indeed as the father of MMT? And what role do you see MMT potentially playing within an emerging market? Remembering that, of course, most of the authors, Randall Wray and others, of course, have pitched their understanding of MMT very much from within the US system and the very privileged position that the US has. Don't know who wants to give a first bash at that.
I can start. I like to separate a couple of points about MMT. First, I think one needs to understand MMT both as an economic proposition theory, but as well as a political movement. So one needs to. They are very active. They are very active in the political sphere, above all in the US. And I would say that, generally speaking, I do share their political engagement in the US and their proposals. There are things that can be implemented. There are MMT policies that can be implemented, and actually I would say they are being implemented. For instance, regarding different types of job guarantees in India, I think there are propositions to that extent in South Africa. In India, there is the Gandhi rural job program, something like that, that is interesting, and I support that. But the main difficulty of MMT, and some MMT scholars acknowledge it, is the issue of sovereignty. It's not a you have it or you don't. It's a spectrum. There is a hierarchy, and that goes to the first question, that is, not all emerging economies are the same. So there are limits imposed by this, by the lack of sovereignty, because not all emerging economies currencies are internationally accepted. I would say very few, if are accepted internationally. So that puts a first constraint on your sovereignty, because it also impacts on how your currency is accepted domestically. The international acceptance also influences the domestic acceptance. So there is this, the border between external and domestic sovereignty is porous. It has numerous holes in it, and that affects the degree of autonomy and policy space of governments. And It also reflects, for instance, in their fear of currency depreciation, which is, and for good reasons, for the fear of substantial currency depreciation, which may trigger inflation, etc., and redistributive transfers within the economy, which, in my view, it's a bit understated by MMT supporters.
Thank you. Anastasia, do you see Minsky as the father of MMT?
On the contrary, Minsky was a scholar of financial innovation. He understood precisely, again, much ahead of his time, just how important in the continual innovation in monetary, quasi-monetary financial instruments is from the private sphere, how it stretches the financial system, how destabilizing it can be, how it can create a sense of financial prosperity or overall wealth. Whereas MMT is doing everything, or all the logic of its thinking is to abstract from the reality of financial markets, financial innovations, the importance of derivatives, pricing, and kind of have a very closed model of economic thinking. So now I would say that although Minsky is being used by some to suggest that he might be the father figure for this particular current, I would say not at all. He's not for me. He will never be. I think, although money was a central concept for him, he understood the complexity of the financial system that is beyond the monetary or even the banking system. Finance is a much more complex sphere than just the sphere of money supply, although there are borders and boundaries. Whereas on a broader conceptual level, I'm a great skeptic of MMT, partly because I don't particularly think it's theoretical tradition. I would agree political movement, and I think that there is richness in the legacy of economic thinking to deliver the message that the socio-political message that MMT has in mind, without relying on some artificial assumptions of the closed economy that MMT rests upon. So no, the answer is no.
Thank you very much. I think there was also a very interesting discussion, a point that you raised about Minsky with regard to hedge, speculative and Ponzi financing. And you made the point that Minsky was indeed, saw speculation as fairly benign. I remember once speaking to Victoria Chick about Minsky. She was in fact taught by him, and he used to have a very close relationship with those guys who were trading on Wall Street, and they would have their seminars in the pub and discuss with the brokers and traders. And so it could well be that because he had a simpatico with that particular profession, that he saw it in this way. But if you think about these different types of finance that he has, and indeed his emphasis on the importance of innovation, finance as an innovator, and the need for this innovation, what in your view, given that of course there is this concern that the innovation will of course disturb stability, what is the answer to trying to grapple with this innovative thrust in finance?
Difficult question without a very easy answer that would come immediately. I would again resort to Minsky's institutional interpretation of 57 varieties of capitalism. The margins of safety for the economic system would be different depending on your context, on your level of development, on your types of income, types of wealth, and other socioeconomic characteristics. But I think he didn't analyze a socialist economy, although his father was in fact a socialist. He was of a Menshevik tradition, but apparently he had a very difficult relationship with his father. But I think he saw the value of capitalist self innovation in some ways, ability to be reborn, partly through the idea of entrepreneurship, of risk-taking, of the role for businesses, although he was very skeptical of corporate ownership and even, if you want, the power in financial hands. So I would revert to a very kind of often used word as governance, and again as a political economy institution of state regulation, oversight, presence, and the central bank much more, let's say, less independent and much more strategic role as an economic institution for development, to answer the question. But the idea that speculation can be benign for some time, I don't think it's, even for me, it's not controversial anymore, because researching the financial system today, you understand that speculation in the markets is probably one of the least evils or lesser evils in finance today. But what is much more dangerous is opacity, complexity, and the dynamics that you don't necessarily observe readily as a regulator. That they can really conceal the nodes, the risks, the systemic threats that would threaten the stability of the system. The whole speculation is in some way the easiest to deal with, and perhaps that's why a lot of asset bubbles are not really dealt with by authorities, because really they are fairly on a spectrum of things. They are actually, we at least know what to do when they implode.
Okay. Pablo, maybe you can talk to us a little bit about how you see financialization and financial liberalization. One of the questions that was raised was, do you see financial liberalization as a form of financialization? How would you describe that?
Yes, I think they are linked. I think that there is a combo of a mix of a bucket of policies that goes around with financialization, and financial liberalization is notably top in the list. One can mention, for instance, more perhaps externally oriented cash flow management of firms. That's a typical issue in emerging economies, especially in big firms. That is one of the typical features of financialization. There has been growing household indebtedness in emerging economies. One can see that in many countries, in Brazil, in Latin America, and one can see it in Brazil, Mexico, Chile, etc. There is also a great push for pension funds involvement and development, and patterns of investment in pension funds management. So yes, and on the other side, the growth, financial liberalization, is tied to one of the defining features of financialization, which is the growth of the financial sector. Every single financial liberalization episode had I don't know if to use the word excessive, but certainly fast and accelerated growth of the financial sector in terms of accelerated lending, in terms of a new array of investment instruments. So they go hand in hand. It's perhaps one of the channels through which financialization usually increases its management over the whole economies in developing countries. yes, so I think they are tightly linked, along with central bank independence, along with pension reforms, etc., etc.
So a lot of it, of course, is around enhancing the power of the financial sector within the economy in so many ways.
Yeah.
You know, we have only a few minutes left before we come to the end of our time, and then the session will shut down, and then there will be the general discussion available at 4:15. But there is an opportunity for both you and Anastasia to close off, perhaps round off, raise points that perhaps you didn't get a chance because I cut you short. Apologies for that. Or issues that you'd just like to address in the Q&As.
Let me start briefly. There have been quite a number of questions, but what I do want to say, perhaps in order to link my presentation to the one of Anastasia, is that capitalism evolves. It evolves, it changes, it transforms itself through innovation, through adaptation, through policy responses to these innovations. So there needs to be a dynamic approach in regulation, in policy making, in order to catch up and to mold, to affect this transformation, to guide it, these innovations. So there needs to be always we shouldn't, and policymakers shouldn't, think of the role as passive, but as active and proactive, not merely reactive towards this innovation character of capitalism, which probably was already present in Marx. I mean, it was highlighted by Marx already so many years ago. That would be my closing.
Thank you.
Let me pick up on the earlier question of financialization and liberalization, because it's in some way I thought the presentation would be on this. I would say that there hasn't been there hardly has been a term in economic jargon that is so in some way prolific, rich, but also counterproductive as financialization. There are, I think, 51 varieties of definition of financialization. There is no agreed consensus, although Penny mentioned that mostly we talk about particular power or measurement of this power of financial institutions and motives. But I think when it's fantastic from an academic point of view, you can just build your career on one term and discuss it from various angles and write incessantly on financialization. But from a practical point of view, from the point of view of understanding the system as a whole, it's completely unhelpful, partly because it fundamentally is based on the distinction between something that is not financial and then something that is inherently financial. To me, these things are inseparable. For two reasons. Any economic transaction in capitalism is a legal document. It's a legal process. It's an operation that has a very legal implication and manifestation. And of course, it is financial. It's an accounting operation. It's a financial operation. There is a necessary financial exchange to go with it. So I think, to me, the discussion about finance vis-a-vis the real economy or financialization against something else are always anachronistic. They tend to be anachronistic. Whereas financial liberalization, of course, is a political measure. It's a policy program. It's a paradigm of development for emerging markets or for particular communities that are supposed to install certain instruments, procedures, the regulatory policies to allow more presence, more inclusivity in financial markets and in financial pricing and risk management. So these are two different things. They should not be confused. And politically, financial liberalization has led to many more destructive social cost, economic cost crises than financialization. That is really a made-up word. as I said, fantastic for some, but in practical terms, particularly unhelpful for actually resolving the injustices, inequalities of financial capitalism or financial system.
Thank you. It's a very profound and helpful discussion. Were there any questions that you saw that you felt you would like to? There are a number of very exciting questions, ranging from, do you think that developing countries are in fact now stuck in Ponzi finance in some cases, where they are highly indebted, to, how does one deal with hedge funding? And do you think that the G20 in fact has solutions to reform the global architecture? If you want to go at any of those questions, I think we've still got 3 or 4 minutes.
I see a question here on whether Minsky can be extendable beyond his lifetime. Of course, he died of cancer in 1996. He did not see the Asian financial crisis in the summer of 1997, starting a whole wave of financial contagion through emerging markets, which I think to him would be a vindication of his work, although it now took financial instability to very different contexts, away from financially advanced capitalism of America into emerging markets, that he didn't really concern himself until about the collapse of transition economies, collapse of the Soviet Union and the emergence of transition economies. But yes, certainly, that's why I keep saying he was very much ahead of his time. He understood the nodes of institutional connections between finance and the rest of economy to really give us, I'm not saying a model, but at least a framework to understand the crises that we are facing now, and we did certainly faced in 2007. But Minsky moment is used for something that was not of his concern at all. Assuming Minsky was alive in our contemporary COVID, would his conceptual perspective on current interactions between COVID breakdowns and survival of economic dynamics? He probably would say that during COVID, at least in short term, the two institutions, the bank and the state, actually behaved in some way that he would want them to behave. There was an employment angle, and there was clearly a financial angle. But he would want probably a much more strategic and long-term orientation. And at least my tone of Minskyian voice would be to warn against the return to pre-crisis equilibrium. It's a mistake to assume that in 2019 capitalism was in equilibrium, or an economy was. No, it wasn't. It was already skewed by austerity policies, by misdirected resources, by, again, oligarchy, corporate evasion, ownership, and financial bubbles or asset bubbles. So that's what I'm saying. This crisis is an opportunity to think institutionally wider in a global context. And yes, G20 did have a plan to act in 2008 and 2009. They had actually quite a developed set of ideas for resolving the legacy of 2007, but then it was corrupted by negotiation and the power of various lobbies and coming from financial system and banks in particular that Penny mentioned. And G20 is the political platform to devise the ideas. Yeah.
Thank you. Pablo, final word from you.
Yes, about net capital inflows and debt as well. For me, the one major thing to have in mind is the capacity to repay debt, right? Whenever you enter into a debt commitment, you need to be relatively certain about the capacity to pay your debt. And that same approach should be used for analyzing external debt. If you borrow for some infrastructure work that will increase your capabilities to afford that debt, that's fine. The problem is that deregulated financial flows do not increase your debt, and in very few instances they increase your capabilities to pay back that debt, and in many instances they diminish that capability actually. So I think that's the framework that needs to be taken when analyzing the importance, the influence of external indebtedness, how it affects your capabilities for future repayments in resources and in dollars, because you usually borrow in a foreign currency.
Thank you. We are doing some exciting work within our division on the mobilizing financial resources in the COVID era. There is a link that I will ask Claire to share with you next time she meets. Please have a look at our work. We are also looking at new ways of thinking about sustainable development finance and debt sustainability. So thank you so much. It's been a fascinating session. Thank you for our excellent speakers.
Thank you.
Bye.
Thank you both. Thank you for the invitation.
Thank you, Claire.